Right now, we're in what I call the deceptive calm. Markets look stable on the surface. The Fed just cut rates again in December, bringing them down to the 4.25 to 4.5% range. Inflation's hovering around 2.8% on their preferred measure. Everything seems manageable, controlled. But that's exactly what makes this moment so dangerous. Because beneath that calm surface, the monetary system is showing cracks that most people aren't seeing yet. And when those cracks finally break through, the speed of what happens next is going to catch millions of people completely off guard. Let me show you what I'm seeing that has me so concerned right now. The Federal Reserve is in an impossible position. They've spent the last few years trying to fight inflation by raising rates to levels we haven't seen in decades. And it worked, sort of. They got inflation down from over 9% to under 3%. Mission accomplished, right? Not even close. Because here's what actually happened. They raised rates so aggressively that they created massive stress throughout the entire financial system. Banks started failing. Silicon Valley Bank collapsed. First Republic went under. Credit Suisse, a 167-year-old institution, had to be emergency merged to prevent a complete meltdown. The commercial real estate market started cracking. Corporate debt became unsustainable for thousands of companies, so now they're cutting rates again. They have to. The alternative is watching the financial system implode in real time. But here's the trap they're in. Inflation isn't actually solved. It's just paused. The moment they cut rates meaningfully, the moment they start making money cheap again, all that inflationary pressure comes roaring back. Except this time, it's coming back into a system that's already weakened, already stressed, already on the edge. Think about what that means. They can't keep rates high without breaking the system, but they can't lower rates without reigniting inflation. There's no good option here. They're trapped between two catastrophic outcomes, and they're trying to thread a needle that might not even have a hole. JP Morgan just came out and said there's a 40% chance of recession by the end of 2025. 40%. That's not some fringe doom and gloom prediction. That's one of the largest banks in the world saying there's nearly a coin flip chance the economy falls apart in the next 12 months. But here's what's really interesting. UCLA Anderson's forecast says they see no signs of imminent recession. Jobs are still being added. Unemployment is still relatively low. The economy looks okay on paper. So who's right? Are we heading for recession or not? The answer is both. And that's what makes this so dangerous. See, what we're experiencing right now is what happens in the late stages of every major monetary crisis. There's a period where everything looks fine, where the data seems stable, where people convince themselves that maybe we've avoided the worst. It's the calm before the storm. And it's always the most dangerous time because it's when people let their guard down. Let me take you back to 2007. In the summer of that year, the economy looked pretty good. Sure, there were some problems in the housing market, but nothing catastrophic. The Fed was managing things. Banks were reporting solid earnings. The stock market was near all-time highs. Then August hit. And suddenly, everything changed. Bear Stearns hedge funds collapsed. Credit markets froze. Within months, we were in the worst financial crisis since the Great Depression. But in July 2007, if you'd told people that was coming, they would have called you crazy. The data didn't support it. Everything looked manageable. That's where we are right now. In that July 2007 moment, where the data looks okay, but the underlying structure is fundamentally broken. And the thing about broken structures is they don't give you much warning before they collapse. They hold together, hold together, hold together, and then suddenly they don't. And when they go fast. The Guardian just published a piece warning that the next big financial crisis may already be brewing. They pointed out something crucial. The longer the period between crises, the greater the complacency. And that complacency is pushing asset prices higher and higher, creating exactly the conditions that lead to crashes. Think about that. We're 14 years past the last major crisis. That's a long time. Long enough for people to forget how bad it was. Long enough for a whole new generation of investors to enter the market who've never experienced a real crash. Long enough for risk to build up in places nobody's watching. And where is that risk building? Everywhere. Corporate debt is at record levels. Companies borrowed trillions when rates were near zero, and now they're facing refinancing that debt at much higher rates. Many of them can't afford it. We're going to see a wave of corporate defaults unlike anything we've seen in decades. Commercial real estate is imploding. Office buildings are sitting empty because of remote work. Retail spaces are vacant because of e-commerce. Property values are collapsing, and the banks that lent against those properties are sitting on massive unrealized losses. They're not failing yet, but the losses are there. hidden on balance sheets, waiting. Government debt is spiraling out of control. The U.S. is adding trillions to the national debt every year. Interest payments on that debt are now one of the largest line items in the federal budget. And as rates stay elevated, those interest payments keep growing. At some point, that becomes unsustainable. At some point, the market loses confidence in the government's ability to service that debt. And when that happens, when confidence breaks, everything breaks. Because modern monetary systems run on confidence. The dollar has value because people believe it has value. Government bonds are considered safe because people believe they're safe. The entire system is built on collective belief, collective trust. But what happens when that trust starts to crack? We're already seeing the early signs. Central banks around the world are buying gold at record pace. They're diversifying away from dollars. They're preparing for a world where the current monetary system doesn't work anymore. The BRICS nations are actively working on alternatives to the dollar for international trade. They're building payment systems that bypass the Western financial infrastructure. They're accumulating gold and other hard assets. They're preparing for a monetary reset. And they're not doing this because they think everything's fine. They're doing it because they see what's coming. Now, I want to pause here for a second, because this affects a lot of people's retirement security. If you're sitting on a significant amount in retirement accounts, 6 figures or more, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics, how to get physical gold into your retirement account without tax penalties, what the process actually looks like. It's in the description if that's relevant to your situation. Worth understanding your options before things get more volatile. Anyway, back to what's happening in the monetary system. The Fed's own data shows something fascinating. The money supply contracted for the first time since the Great Depression. M2 money supply actually went down. That's deflationary. That's the kind of thing that happens before major economic contractions. But at the same time, the Fed's balance sheet is still massive. They're still holding trillions in assets they bought during the pandemic. They're trying to reduce it, but they can't do it too fast without causing market chaos. So they're stuck. They need to tighten to fight inflation, but they can't tighten too much without breaking things. They need to support the economy, but they can't support it too much without reigniting inflation. It's an impossible situation. And the longer it goes on, the more unstable it becomes. Here's what most people don't understand about monetary crises. They don't happen gradually. They happen suddenly. You go from everything's fine to everything's broken in a matter of days, sometimes hours. In 2008, Lehman Brothers went from a functioning investment bank to bankrupt in a weekend. Bear Stearns was sold for $2 a share in an emergency weekend deal. Washington Mutual, the largest savings and loan in U.S. history, failed overnight. When confidence breaks, it breaks fast. And once it breaks, it's almost impossible to restore. The Fed knows this. That's why they're so careful with their language. That's why every statement is parsed and analyzed. They're trying to maintain confidence while simultaneously dealing with problems that threaten to overwhelm them. But here's the thing about confidence. It's fragile. It's based on perception, not reality. And right now, the perception is starting to shift. Inflation expectations are rising again. People are starting to doubt the Fed's ability to control prices. They're seeing grocery bills that are still 25% higher than a few years ago. They're seeing rent that keeps climbing. They're seeing insurance costs that have doubled. The official inflation number might say 2.8%, but people's lived experience is very different. And when there's a gap between official numbers and lived experience, trust erodes. That erosion of trust is what leads to monetary crises. Because once people stop believing in the currency, once they start looking for alternatives, the whole system becomes unstable. And we're seeing that search for alternatives accelerate. Bitcoin hit new all-time highs. Gold is trading near record levels. Real estate, despite higher rates, is still seeing strong demand in certain markets. People are trying to get their wealth out of pure fiat currency and into things that can't be printed. That's a warning sign. That's people voting with their money, saying they don't trust the long-term value of the dollar. Now, some analysts are predicting a major correction coming. There's talk of Bitcoin crashing back to 5 figures. Stock market corrections, gold pulling back from these elevated levels. And you know what? They might be right in the short term. Markets don't go straight up. Corrections happen. Volatility is normal. But here's what matters more than short-term price movements. The underlying fundamentals haven't changed. The debt is still growing. The monetary system is still broken. The Fed is still trapped. So even if we get a correction, even if prices pull back, the long-term trajectory hasn't changed. If anything, a correction just gives you a better entry point before the next leg up. Because ultimately, This isn't about predicting the next 3 months. This is about understanding the next 3 to 5 years. And when you look at that time frame, when you look at the structural problems in the monetary system, there's really only one way this resolves. Either we get massive inflation as the Fed chooses to print rather than allow deflation and depression, or we get a complete restructuring of the monetary system. Those are the two paths, and both of them are incredibly bullish for hard assets. Think about the historical parallels. In 1971, when Nixon closed the gold window and ended dollar convertibility, gold went from $35 an ounce to over $800 by 1980. That's a 22x increase in less than a decade. Why? Because the monetary system fundamentally changed. The dollar was no longer backed by anything except faith in the government. And when people realized that, when they understood what it meant, they rushed into hard assets. We're in a similar moment now. The difference is, this time the debt levels are exponentially higher. The money printing has been exponentially larger. The distortions in the system are exponentially greater. So when this breaks, when the calm ends and the storm hits, the moves are going to be exponentially bigger. And here's the scary part. Most people aren't prepared. Most people are still operating under the assumption that the system is stable, that the Fed has everything under control, that their dollars will maintain purchasing power. They're going to be shocked by what happens next. I'm not saying this to scare you. I'm saying this because understanding what's coming gives you time to prepare. It gives you time to position yourself correctly. It gives you time to protect what you've built. The monetary storm that's coming isn't a maybe. It's a when. The structural problems are too big. The debt is too large. The Fed's options are too limited. Something has to give. And when it does, the speed of the change is going to be breathtaking. So, what do? How do you prepare for something like this? First, understand that cash is not safety. Holding dollars in a bank account might feel safe, but if the dollar loses purchasing power rapidly, that safety is an illusion. You're watching your wealth erode in real time. Second, diversify into hard assets, things that can't be printed, that have intrinsic value, that have maintained worth across thousands of years of monetary chaos. Gold, silver, real estate, productive assets, things that will hold value regardless of what happens to paper currency. Third, reduce debt where possible. In an inflationary environment, debt can actually be beneficial because you're paying it back with devalued currency. But in a deflationary collapse, debt becomes crushing. You want to be positioned for either scenario. Fourth, build skills and relationships. In times of monetary chaos, your ability to provide value to others becomes crucial. Your network becomes crucial. These are things that transcend currency. And fifth, stay informed. Don't rely on mainstream narratives that everything's fine. Look at the data yourself. Watch what central banks are doing, not what they're saying. Follow the money. The calm we're experiencing right now is temporary. It's the pause before the acceleration. It's the moment of stillness before the wave hits. And that wave is coming. The monetary storm is building. The structural problems are too severe to avoid it. The question isn't whether it's coming. The question is whether you'll be ready when it arrives. Because when this breaks, when the calm ends, there won't be time to prepare. There won't be time to reposition. There won't be time to figure out what to do. The people who survive monetary crises, who thrive during them, are the ones who saw it coming and prepared in advance. They're the ones who understood that the calm was deceptive, that the stability was temporary, that the storm was inevitable. Right now, you have that opportunity. You have time to look at your situation, assess your exposure, and make changes. You have time to move from vulnerable positions to strong positions. You have time to prepare, but that window is closing. Every day that passes, every month of this deceptive calm, brings us closer to the moment when everything changes. The Fed's December rate cut isn't a sign that everything's getting better. It's a sign that they're so worried about the economy breaking that they're willing to risk reigniting inflation. That's not strength. That's desperation. The fact that major banks are talking about 40% recession odds isn't reassuring. It's terrifying, because banks don't make those kinds of predictions lightly. They have access to data and analysis that most people never see, and they're seeing something that has them deeply concerned. The fact that central banks are buying gold at record pace isn't random. They're preparing for a monetary reset. They're positioning for a world where the current system doesn't work anymore. All of these are warning signs. All of these are telling you that the calm is temporary, that the storm is coming, that you need to prepare. So here's my challenge to you. Don't wait. Don't assume you have more time. Don't believe the narrative that everything's under control. Look at the data yourself. Look at the debt levels. Look at the Fed's impossible position. Look at what central banks are doing. Look at the structural problems in the system. And then ask yourself, am I positioned for what's coming? Am I protected if the monetary system breaks? Am I prepared for rapid inflation or deflation? Am I ready for the storm? Because it's coming. The calm is ending. And when the storm hits, it's going to reshape the financial landscape in ways most people can't imagine. The question is whether you'll be ready, whether you'll be positioned correctly, whether you'll be one of the people who saw it coming and prepared, or one of the people who gets caught off guard when everything changes. This is your warning. This is your moment to act. The calm before the monetary storm won't last forever. Use it wisely.